Hi candidates, welcome to another session of manifested online classes. So we are still soldiering on with the topic of group accounts. So in this session, I want us we look on specific standards which are applicable during the preparation of group accounts. Remember, in our first lesson, we were able to define what are group accounts, and basically we said group accounts are supposed to be prepared by the parent entity which has interest in other companies or in other entities, and we were also able to define various terms like what is a group of companies, what is a parent entity, what is a subsidiary, and so on. So in this particular session, I want us to look on various accounting standards which are applicable during the preparation of the group account, and then from there we can go ahead and basically look on some of those particular standards, including IFRS 3 and so on. And therefore, here we can say that the following accounting standards are applicable in preparation of group accounts, preparation of group accounts, preparation of group accounts. So number one, we have IFRS 3, which deals with the issue to do with the business combination. Combination. Number two, we have IFRS 10. These relate to preparation of consolidated financial statement, whereby the parent company has invested in a subsidiary. Investment in a subsidiary, how the parent company should prepare the group account, whereby it has invested in a subsidiary. So then we also have another standard which is applicable, that is International Accounting Standard number 28. So this deals with the investment in associate and joint venture. So how to prepare the group account whenever the parent company has invested in an associate or a joint venture. And then the other standard which is applicable here is International Financial Reporting Standard number 31, which basically deals with the preparation of group accounts whereby the parent company has invested in a joint arrangement. So therefore, these are some of the accounting standards which we are going to come across in this particular topic, specifically during the preparation of what we refer as the group account. So I want us to start with the first one here, that is IFRS 3, International Financial Reporting Standard number 3, IFRS 3, and these deals with the business combination. Recall that this is a term we defined in our first session, and we said that a business combination is that particular transaction or even the events through which now the parent entity acquires control over the subsidiary. The subsidiary. So mean that whenever the parent company here, the parent company has invested, or in other terms has acquired a subsidiary company, that particular transaction itself, we refer to it as a business combination. So according to this particular standard here, that is IFRS 3, it requires that once the parent company has invested or basically acquired a subsidiary, on the date of acquisition, the parent company should determine whether that particular subsidiary has been acquired at a goodwill or something called a gain on bargain purchase. A gain on bargain what? A purchase. And therefore, this particular standard here has gone further and basically prescribe some rules regarding the computation of goodwill, or basically has outlined the various methods to be used by the parent company in computing or basically determining the goodwill arising from the business combination. But even before we look on the computation of the same, we can say that IFRS 3 requires the parent entity to determine goodwill arising from business combination on the date of acquisition. And this particular date of acquisition here, this one we abbreviate it as DOA. That is the date of acquisition. Acquisition. So therefore, on the date the parent entity or the parent company has acquired a subsidiary, the parent company should determine whether that particular subsidiary was acquired at a goodwill or something known as a gain on bargain purchase. And before we look on how we determine this particular goodwill arising from business combination, first of all, what is goodwill? We need to define what goodwill is. So when talk about the goodwill here, basically this refers to any difference between the purchase consideration which will be paid by the parent company and the net assets which have been acquired. The difference between purchase consideration paid by the parent entity and the fair value of the net assets which have been acquired. So therefore you can say that this is the difference between purchase consideration paid by the parent entity and fair value of net assets acquired. So in this case, it is obvious that once the parent entity here has acquired majority of the shares in the subsidiary, the parent company must pay for those particular shares. So the amount of money which has been paid by the parent company, that amount we refer to it as the purchase consideration. For example, in this case, if you are told the parent company acquired 80% of the shares issued by the subsidiary company, we can be told that the parent company, for example, paid 100 million for the shares now which were acquired. So this 100 million is what we refer as a purchase consideration. So any difference between what has been paid and the net asset which have been acquired by the parent company, that difference is a goodwill, or it can be a gain on bargain purchase. Now, this particular standard here, IFRS 3, we are saying it outlines how that goodwill should be determined, and also it outlines the two methods the parent entity should be able to use to compute the goodwill arising from the business combination. So therefore, in this case, we can say that there are two methods of determining the goodwill arising from business combination. So which are those two methods? Number one, we have the full goodwill method. And number two, we have the partial goodwill method. So two methods, the full goodwill method and the partial goodwill method. So let's start with the first method here, and that is the full goodwill method. So under this particular method here, that is the full goodwill method, we compute the goodwill attributable to both the parent entity and also the non-controlling interest. So we can therefore say that the goodwill determined under this method is attributable to both parent company and NCI. So you have to recall that when talk about the NCI, we are talking of the minority shareholders. Like maybe in this case, what I've said is that if we are told that the parent company acquired 80% of the shares issued by the subsidiary, it means that the remaining 20% of the shares issued by this company, those shares are held by who? Minority shareholders. And we have said the interest of the minority shareholders, we refer to it as the non-controlling interest. So therefore what you are saying is that under this particular method here, that is a full goodwill method, the goodwill which is computed or determined is the goodwill attributable to both the parent company and also the NCI. And then the NCI. So how do we compute this particular goodwill under the full goodwill method? So let's look on how we determine this particular goodwill. We refer to it as a goodwill on acquisition, or in other terms, we can just refer to it as the goodwill arising from business combination. So in this case, we need to have two columns here. So always we start with the purchase consideration paid by parent entity, parent entity. When the parent entity acquired its shares, or for example in this case, when the parent entity acquired 80% of the shares in the subsidiary, how much amount was paid by the parent entity? And then to this we add something called NCI at fair value. So what is NCI at fair value? NCI at fair value in very simple terms, this is a purchase consideration paid by the minority shareholders when they acquired their 20% or when they acquired their shares in the subsidiary. Mostly this figure will be given to you by the examiner. The examiner will give you the NCI at fair value on the date of acquisition. Alternatively, if that figure is not given, because there are some instances whereby the examiner will not give you that, there is a way how we compute it. Because what you just need to do is to determine the shares acquired by the minority shareholders here. If, for example, this company has issued like 1 million shares and the parent company acquired 80%, it means that the minority shareholders then acquired 20% of these shares. 20% of 1 million. So that give you the shares acquired by the minority shareholders. And then what you do, you multiply those particular shares with their fair value. The fair value of the shares is the market price, because when buying the shares in a company, you pay a price equivalent to the fair value, a price equivalent to the market price. So therefore, if that value is not given to you by the examiner, that's how you compute it. Determine the shares held by the minority shareholders here, multiply that with the fair value per share. And then to this, add the two values. Then you proceed and you less a fair value of net assets, acquired, acquired. Now, this is something else which in most of the cases the examiner will not provide, and if this figure is not provided to you, or you are not given this particular figure by the examiner, there is how we compute it, because what we want to determine here is the net assets which were acquired by the parent company and the minority shareholders in this particular subsidiary. So if that figure is not given, how do we compute this then? So number one, we take the subsidiary company. Ordinary share capital. share capital, and then to this we add the subsidiary company pre-acquisition reserves. Pre-acquisition reserves. So what do you mean by pre-acquisition reserves? When talk about the pre-acquisition reserves, we are talking of the reserves which the subsidiary company was having at the date of acquisition. And actually, when we talk about the reserves of the subsidiary, we are talking of things like the share premium, things like the revaluation reserve, things like what if as what? Maybe general reserves and so on. So therefore, you check which reserve the subsidiary company was having at the date of acquisition. You take them into account here, and then you add you add that now to the subsidiary company ordinary share capital, and then because you are interested with the net asset acquired by the parent and also the NCI, so what you do, you take 100% of this, 100% of that. So 100% of the figure which you'll get there, you take it to the last column here, take it to the last column, and then you less it from the total amount which you have up here. So here you can get a positive figure. So if you get a positive figure, we say that that is goodwill arising from acquisition, but there are some cases whereby you can get a negative figure. So if you get a negative figure, previously that was known as a negative goodwill, but currently that one we refer to it as a gain on bargain purchase, a gain on bargain purchase. So a positive figure we are saying is a goodwill, whereas a negative figure there we are saying is a gain on bargain what? Purchase. So therefore, this is how we compute now the goodwill arising from acquisition using the full goodwill method. Number one, you have said we take the purchase consideration paid by the parent company, and then to this we add the NCI at fair value, which may be given or some cases may not be given. If it is not given, I've explained how we compute that. Then get the total, and then to this you proceed, you less the fair value of the net asset acquired by both the parent and also NCI. Remember here we are interested with the goodwill of the parent and also the goodwill of what? Of NCI. So that's why we are saying you less the net asset acquired by both the parent and NCI. And actually you can see, that's why you can see here we are taking 100% of the net asset of this subsidiary because we're interested with the asset acquired by the parent, the asset acquired by who? NCI. Take 100%. So you less that from the figure which we have up there. If you get a positive figure, is a goodwill. If you get a negative figure, is what? Is a gain on bargain what? A purchase. It's also important here to mention that a goodwill which arises from the business combination. This particular goodwill now, which you get here, this one is recognized as an asset, as a non-current asset by the parent entity. So mean that when the parent entity is preparing the consolidated statement of financial position, this one will be recognized as an asset, and then IFRS, not IFRS, but rather IAS 16, requires that the parent entity at the end of each year should basically determine whether this particular goodwill has done what? Has impaired. So therefore you can say goodwill is recognized as an asset in the consolidated statement of financial position, in the consolidated balance sheet, and reviewed for impairment on annual basis. So being reviewed for impairment, what that means is that the parent entity, or basically the parent company, at the end of each year should basically determine whether the value of the goodwill has reduced. So if the value of the goodwill has reduced, then that reduction in the value of the goodwill is an impairment loss, and basically that impairment loss is then recognized as an expense in the consolidated statement of financial position. Maybe also we can mention that here, and we say any reduction in the value of goodwill, which now is an impairment loss, which is an impairment loss, is recognized as administrative expense in consolidated income statement. Consolidated income what? A statement. So therefore, it's very, very important that this particular goodwill is recognized as a non-current asset in the statement of financial position and also reviewed for impairment on annual basis. Any reduction in the value of the goodwill, then you're saying is recognized as administrative expense in the consolidated income what? A statement. What about this particular gain on bargain purchase? Now, when talk about a gain on bargain purchase, basically this means that the purchase consideration which was paid by both the parent and also NCI in acquiring the net asset or in acquiring the shares of the subsidiary company was less than the net asset which were acquired. Basically what that means is that the minority shareholders, the parent, acquired the subsidiary at a profit. That's why we are referring to that as a gain on bargain what? A purchase. And this particular gain on bargain purchase, according to IFRS 3, it should then be recognized as an income in the consolidated income what? A statement. So therefore, you can say so that a gain on bargain purchase is recognized as an income, or basically as part of other incomes, is recognized as an income in the consolidated statement of profit or loss. Consolidated statement of profit or loss. Immediately or at the end of the year, this particular gain on bargain purchase will be recognized as an income whenever the parent entity is preparing what? Is preparing the consolidated income statement. So basically, we are done with the first method. So let's look on the other method here. That is the partial goodwill method. Partial goodwill method. Method. So under this particular method here, goodwill which is computed is attributable to the parent entity only. So in other terms, we can say that under the partial goodwill method, we only determine the goodwill attributable to the parent entity. So mean that that goodwill does not include the goodwill of what? Of the NCI. So therefore, you can say under this method, the goodwill determined is attributable to parent entity only. To parent entity only. So we determine the goodwill attributable to the parent entity, only. So how do we determine the same? So let's look on how we compute this particular goodwill here under the partial goodwill method. So we look on how we determine the goodwill on acquisition using the partial goodwill method. So equally here we need to have two columns. So we start with the what? We start with the purchase consideration paid by the parent entity. Purchase consideration paid by the parent entity, or basically the parent company. And then to this we less the fair value of net assets. Fair value of net assets acquired by a parent entity. acquired by parent entity. So remember, in this particular case, what you have said here is that in computation of goodwill, mostly there is something which the examiner will not give you. The examiner will not give you the fair value of the subsidiary company net asset on the date of acquisition. And basically, I've said that if that figure is not given to you, this is how you compute it. You take the subsidiary company ordinary share capital plus now the subsidiary company pre-acquisition reserves. So pre-acquisition reserves, you have said that these are the reserves now the subsidiary company was having on the date it was acquired. So therefore, in terms of how we compute the subsidiary company net asset on the date of acquisition, I've said we take the subsidiary company ordinary share capital, and then to this we add the pre-acquisition, that is still the subsidiary company pre-acquisition reserves. Pre-acquisition reserves have said that these are the reserves the subsidiary company was having on the date of acquisition, which include retained earnings, the revaluation reserve, general reserves, and so on. So we get the total here, and then we have now to multiply that with the parent company shareholding in the subsidiary. So we multiply that with the parent company shareholding in the subsidiary. So if, for example, the parent company acquired 80% of the shares in the subsidiary, so here we are only interested with the net asset acquired by who? Acquired by the parent. Acquired by the parent. So you get 80% of this. So then you less that from the figure which we have up there. So you can get a positive figure which is a goodwill. You can get a negative figure which is a gain on bargain what? Purchase. So if you get a positive figure is a goodwill. If you get a negative figure here is a gain on bargain purchase. And in this case I've explained how we account for this, because I've said that any goodwill arising from business combination will be recognized as an asset in the consolidated statement of financial position and then reviewed for impairment on annual basis. And any reduction in the value of the goodwill is equally recognized as an expense in the consolidated income statement. And then you have said that this particular gain on bargain purchase will be recognized as an income in the consolidated income what? Statement. So therefore, these are the two methods which are used by the parent entity in determining the goodwill arising from the business what? Combination. But mostly once you come across a question in an exam setup, the examiner will not tell you specifically which method to use, either the full goodwill or the partial goodwill method, but mostly you will come across some statement in the additional information. You will come across a statement in the additional information. For example, number one, you can be told that it is the group policy. It is the group policy. The group policy to measure NCI, that is non-controlling interest, at fair or full value. At fair or full value, in which case the examiner will proceed and further give you something called the NCI at fair value. So if you come across this particular statement in the additional information, it means that when computing the goodwill here, you're going to compute the goodwill using the full goodwill method. The full goodwill method. So if you come across a statement that it is a policy of the group to measure the NCI at fair or full value, in which case the examiner has also provided you the NCI at fair value, compute the goodwill using what? The full goodwill method. Alternatively, you may come across information, or you may be given some information by the examiner that it is the group policy. The group policy to measure NCI at their proportionate share of net assets, of net worth, asset. So if you come across this particular statement here, one, the examiner will not give you what we refer as the NCI at fair value, and therefore it means that in this case, when computing the goodwill arising from business combination, then you use the partial goodwill method. You use the partial goodwill method. So therefore, this is very, very important, because now this is the information which you'll come across in this particular question for group account, and this is the information which should guide you how to compute the goodwill arising from the business combination. So you can use either the full goodwill method, but if you come across this particular statement that is a policy of the group to measure NCI at fair or full value, and the examiner will further provide you that information, will give you the NCI at fair value, which then you need to use there. So alternatively, you can be told is a group policy to do what? To measure NCI at their proportionate share of what? Of the net asset, of the net asset. So therefore, that basically what you need to know as far as IFRS 3 is concerned, the computation of goodwill, what is goodwill, and the various methods which are used in the computation of goodwill, the full goodwill method, the partial goodwill method, and actually how we compute those particular goodwill, in which case you have said that any goodwill arising from business combination is recognized as an asset, actually a non-current asset in the consolidated statement of financial position, and then on annual basis it must be reviewed for impairment, and then in case there is a gain on bargain purchase, we have said that one is recognized as part of other incomes in the consolidated income statement. So I want us to stop at that point. So once we come back in our next session, we're going to look on some illustrations regarding the computation of goodwill using the two methods here, the partial goodwill method and the full goodwill method. So see you in the next session.